Good afternoon, everyone. Let me first give you an overview of the company, followed by business updates. ADF Foods is a leading consumer-focused company and a leader in prepared ethnic food. We manufacture, distribute, and market South Asian food both in India as well as globally in over 55 countries. We have 8 distinctive brands in our portfolio, each catering to a certain demographic and have a strong consumer following. These brands cater to the South Asian diaspora, global mainstream, as well as domestic consumers. Our flagship brand, Ashoka, is growing at a CAGR of upwards of 30%. Our products are manufactured both in-house at our Nadiad and Nasik plants, which have a combined capacity of 28,000 metric tons. We also have a branded foods agency business for distribution of select FMCG products. These are renowned brands including Lipton, Brook Bond, Red Label, Taj Mahal, and No Soups. This substantially broadens our offering and enhances our store presence in overseas countries. This combination of our own brands as well as our agency-backed business, backed by our manufacturing strength, has contributed to healthy EBITDA margins in the range of 20%, powered by a debt-free balance sheet. We continue to make investments in our brand and our manufacturing capabilities for long-term growth. Coming to the business updates, we had a satisfactory growth as well as healthy margins over the past 9 months as we focused on brand building and investing in profitable products. We saw stable demand for both our processed foods as well as the agency distribution business. Our Q3 revenue growth could have been better, however, the Red Sea crisis impacted sales shipments towards the end of the quarter. We initiated several new plans to accelerate our long-term growth. The board approval for investment in Telleric Foods will enable us to accelerate our India business growth. Further, the merger of our subsidiaries ADF Foods and Telleric Foods will enable us to achieve substantial synergies, including efficient capital utilization, flexibility in business operations, and cost rationalization. We continue to witness healthy demand for our products, and in order to support the same, we launched several new products under our flagship brand, Ashoka. These were across various categories, including frozen desserts, canned sweets, and Indo-Chinese sauces. Overall, we expect all of the above initiatives to enhance our growth and increase our profitability as well over the long term. I now hand over to our CFO, Shardul Doshi, for his comments on the financials.
Thank you, Sumit. Good evening, everyone. I'll first share the standalone performance. For the 9 months that ended on December 31st, 2023, we recorded revenues from operations worth rupees 285.2 crores, an 11.8% increase from the same period last year. Our EBITDA was rupees 70.2 crores, a 44.6% increase Y-on-Y. We managed to expand the EBITDA margin by 560 basis points, reaching 24.6%. We see this as a tangible outcome of our continuous focus on investing in our brands and innovating in our product portfolio. Our PAT was rupees 54.3 crores, a 36.8% increase from the previous year, with a PAT margin of 19.1%, an improvement of 350 basis points from the last year. Now let us look at the quarterly figures. In Q3 of financial year 2024, we saw revenues from operations rise to rupees 103.2 crores. This marks a 3.5% Y-on-Y growth and a 6% Q-on-Q increase. Our EBITDA for this quarter was rupees 26.4 crores, a Y-on-Y increase of 2.7% and Q-on-Q increase of 16.6%, while our EBITDA margin was 25.6%. As Sumer mentioned, our Q3 revenues could have been better. However, our sales shipments were somewhat impacted by the crisis in the Red Sea towards the end of the quarter. This led to a marginal impact on the revenues as well as our EBITDA. Hence, both grew at a slower pace on a Y-on-Y basis. PAT for the quarter was rupees 20.3 crores, a 5.4% increase Y-on-Y and 14.4% increase Q-on-Q. Our PAT margin for this quarter stood at 19.6%, an improvement of 30 basis points from the previous year. Moving on to consolidated performance, for the 9 months ended 31st December 2023, revenue from operations was rupees 366.7 crores, a 12.1% increase Y-on-Y. EBITDA was rupees 70.6 crores, an increase of 30.4% Y-on-Y. EBITDA margin stood at 19.3%, expanding by 270 basis points Y-on-Y. Profit after tax was rupees 48.8 crores, up 22.6% YOY, with a PAT margin of 13.3%, an increase of 110 basis points on a yearly basis. Coming to the quarterly performance, our revenue from operations for Q3 FY24 was rupees 129.7 crores, an increase of 5.2% YOY and 4% increase from the last quarter. Our EBITDA for Q3 FY24 was rupees 27 crores, recording a small decrease of 0.4% YOY, but an increase of 23.8% from the previous quarter. Our EBITDA margin stood at 20.8%. Our PAT for the quarter was rupees 19.1 crores, marking a YOY increase of 3% and quarter-on-quarter increase of 27.9%. For Q3 FY24, the PAT margin stood at 14.7%. Our capex for 9 months period ended December 23 was rupees 3.5 crores in debottlenecking and another 3.5 crores in cold storage projects. Our balance sheet continues to remain debt-free as on date. The board has approved rupees 13 crores in optionally convertible redeemable preference shares investment in our subsidiary Telluric Foods India Limited. This will downstream to Telluric Foods Limited TFL, a step-down wholly owned subsidiary of the company by TFL. The said monies will be used to support the brand building and working capital requirement of TFL. Also, the board approved transfer of ADF's entire equity investment in its wholly owned subsidiary ADF Foods India Limited to its step-down wholly owned subsidiary, which is Telluric Foods Limited, at fair market value to be determined. Post this, a merger is proposed between the company's subsidiaries ADF Foods India Limited, which is a transferor company, and Telluric Foods Limited, which is a transferee company. This proposed merger is already approved in principle by the board. As highlighted by Sumay, the merger is expected to generate substantial cost synergies as well as greater financial strength and flexibility. Overall, we continue to judiciously invest in our manufacturing capabilities as well as our brand building exercise in order to focus on increasing our margin profile as well as deliver greater returns in the long term. With this, I now request Ravi to open the floor for the Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Faisal Hawa, an individual investor. Please go ahead.
So, sir, there is not much progress on the distribution business that we have because I think that Unilever sold some of their. Could you try again? Hello. Go ahead. So Unilever sold off their business to another company, and even Patanjali we are not doing well. So are we giving up on this, or are we in talks with more companies to really expand this, because this is almost like an additional business which goes directly almost to the bottom line for us.
So the distribution business, in fact, as we had pointed out in the last quarter, there were certain issues which we faced on the supply chain issues when the handover happened from Unilever to Lipton, which is where the business they have moved, the entire tea business they have moved. However, saying this, a lot of these issues have been resolved in this quarter. There are still some issues they are still facing in terms of supplying it to us. But our growth, there is a good growth which has happened over Q2 numbers in Q3 when you look at the distribution business. We are also looking at some additional, we have talked to a couple of companies and we will share some details as and when any transactions happen, and we will start selling those products.
And so, second question is that, hello, can you hear me?
Yes. Yes.
So, second question is that how are we doing on our tie-ups with Costco and Walmart, which we are pursuing from a very long time?
So on the supermarket business, it's still a work in progress. So for Costco and Walmart, that's under Truly Indian, which we plan on launching next fiscal year. But supermarkets as a whole, we made some progress. In fact, just yesterday we got listed in 700 outlets in the UK, with one of in fact, the largest supermarket in the UK.
So is it Tesco?
Yes, that's correct.
Okay. So 700 supermarkets at one go we will be now getting access to.
Yeah, but it's just a few SKUs. It's only 3 SKUs.
But we'll be having access to all the 700 stores of Tesco?
That's correct. Yeah.
Okay. So that itself could yield to a lot of quarter-on-quarter growth from here on.
Yeah, so we're hoping at least $1 million in the upcoming financial year.
Okay. And sir, can you give some light on what has led to this huge EBITDA margin increase for us?
The main EBITDA growth which has happened, of course, the margin profile is better when you look at the product mix which we have. Our frozen share is increasing in overall sale. Second, when you look at the Y-on-Y EBITDA growth, in 9 months there was higher freight cost which we were seeing in the last financial year, and that was substantially impacting our bottom line. However, in the current year, first 9 months, the freight cost was lower. Towards end of course, Q3, the freight cost have also started going up, and we will see now how that will shape up in Q4.
Okay. Thanks a lot for answering my questions so well. Appreciate it.
Thank you, sir. We have our next question from the line of Rishi Maheshwari from Aksa Capital. Please go ahead.
Hi, thanks for taking my question. Hi Shardul, hi Sumer. This is to understand, you had earlier projected to grow between 15 to 20%, and you at that point in time, this looked comfortable given the kind of market size that we have, the penetration that we have, the product that we have, and the expansion on the geographical side that we were approaching at. While I look at the 9 month numbers today, there are about 12-13% kind of growth. I believe that we may fall short of our target. What is your view on this in terms of revenue?
So towards the end of the last quarter, we faced that Red Sea issue. So the container availability where that wasn't really, that became a question, and we lost some significant sale in last 15 days of December. However, now that those issues have been resolved, the freight costs of course have gone up, but containers are available, and those orders have actually come into the fourth quarter. So hopefully we will still be able to meet our targets which we have mentioned. In terms of expected numbers, I think we still stand committed to the higher growth in our top line. We have done everything which is required to do that. Our manufacturing capacity we have increased. We have installed our freezer in US. That's in the warehouse. There is investment in people which have happened. There is investment in our Indian business also which we have done. So everything is in place now, and there is of course good order book also for the fourth quarter. So for the year as well as going forward, we expect to meet our numbers which we have been saying in the past.
Sure. Will you be able to let me know what is the contribution of Ashoka within the third quarter numbers?
Ashoka will be in the range of 55 to 60% of our standalone revenue.
Sure, 55 to 60%. Sure. The other part was to understand Nates and PJs. Has that what is any update over there?
No, so nothing is yet. I mean, we did identify a facility last quarter, but it didn't meet our quality requirement, and we still continue to leverage that relationship. I mean, Nates and PJs, as you know, was mainly sold to supermarkets. So we hope to leverage that relationship and now introduce Truly Indian within those same supermarkets where the manufacturing is actually in our control.
I see. Sure. So as of now, we shouldn't build any. Are there any expenses on with relation to Nates and PJs that we were incurring earlier?
We are still incurring. The company is still in existence, and there is a legal case which is going on. However, the fixed costs have significantly reduced. So the last year, we had almost 5 crores of losses from that entity. That's down to half of what we are in the current year.
So while we will not have any revenue from there, will we continue to have these expenses on board in the next year as well?
No, I think significant fixed cost is already reduced. It's just the legal cost which is still we are incurring, and hopefully we will get result of the. I think we will finish with our legal case, and that will also stop in the next financial year.
Your movement, your transition in UK supermarket Tesco, I think is very appreciable. Congratulations on that. Is this 3 SKUs just a pilot product, and therefore should we assume that gradually we will have a lot of our SKUs if this pilot happens to be successful?
So it's actually a permanent listing. In pilots, they roll out to fewer stores, but because this is across the board, we're hoping it's a permanent listing, and then of course they'll decide based on secondary sales.
And what is the potential that you see? I understand you're looking at $1 million perhaps next year, but what is the potential going in the next 3-4 years from, say, Tesco? This is a virgin contract, is that right?
Sorry, what was that?
This is the first time contract with Tesco, is that right?
So we used to sell in Tesco many years ago, but yeah, we just got back in. And in terms of potential, it's hard to say, but we're estimating at least 1 million in the first year. I mean, if you remember a couple quarters back, we got listed in Morrison's and B&M.
Right.
And that next financial year should again move upwards of $1 million, but it's hard to say until we actually see secondary sales.
Sure. What is the expected capex for this year?
So there is, on the cold storage, we have another commitment of 11 crores. So we will finish that project by April of the current year, and the freezer cold storage will be up and running. So that's total 15 crores pending we would have done by then. And in terms of normal capex, there is nothing significant now till March. And the next financial year, again, I think we'll incur another 3-4 crores for our normal capex.
3-4 crore more than your normal capex?
No, 3-4 crores of normal capex in the next financial year.
In FY25?
Yes.
So in FY25, normal capex will only be about 4 crores?
No, I'm not talking about the greenfield. I'm just talking about our existing plants here.
So and any greenfield capex that you've already envisaged?
So greenfield will be around 60 crores to be spent over 15 months starting from April. Yeah.
15 months. All right. Thank you so much. All right. All the best.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Devanshu Sampath from Avendus Wealth. Please go ahead.
Yeah. Hello, sir. Good afternoon.
Hi,
can you hear me?
Yes.
Hi. So, few questions. Can you tell me what was the freight cost this quarter? Sorry, as a percentage of sales.
So it's around 7%.
7%. Okay. And so you also mentioned that you're seeing these rates go up now. So, I mean, in terms of your expectation, do you see this as a percentage of sales going up to a double-digit figure anytime soon?
No. So what's going to happen, I think after last increase in the freight cost, which we had seen, a lot of contracts we have moved to the FOB. So what's going to happen is, it will still impact us maybe, and our profit impact can be around 200 bips here. But when we look at the overall sale increase which we are expecting with the fixed cost apportionment, overall I think we should be in a position to maintain our EBITDA margin there.
Okay. And just to clarify, you're saying this percentage of sales is on a standalone, right, or console number?
Standalone.
7%.
Standalone.
7%. Okay. Should be able to. Okay. And so when it comes to Ashoka, do you think are we on track, or as per your expectations, do you think you can maintain this 30% run rate this year and next year as well? So I mean that would essentially translate to a 350 CR plus kind of a number for FY25. So are we on track to do that?
I think hopefully we should be in a position to maintain. Our Ashoka revenue this year is expected to be around 260 to 270 crores.
This will still be a 30% growth expected this year.
Around 25%, yeah.
Okay.
Sorry to interrupt, sir. May I request you to join the queue for the follow-up question, as there are several participants waiting for their turn.
Sure.
Thank you. We have our next question from the line of Tushar Khurana, an individual investor. Please go ahead, sir. Mr. Tushar? As we are unable to connect with Mr. Tushar, we will go on to the next question. We have a next question from the line of Saurabh Trivedi, an individual investor. Please go ahead.
Good afternoon, sir. Saurabh Trivedi here. I have been with company since last 4 to 5 years. Sir, I have a question regarding our freight charges. The sea issue is going on since last more or less 24 months. So what are we planning about that big cost?
So like Shardul said, we're trying to mitigate the freight impact as much as we can by moving all our contracts from CNF to FOB.
Okay.
Essentially means the freight will be to the customer's account.
Right.
Yeah.
Okay. And sir, how are we planning with India market? Because we have very big plans for India. Right? Suppose because we are on any which ways working on that thing. Right? So what can we expect as an investor and as a customer of Soul brand?
So in India, we're hoping to achieve a revenue of about 100 crores in the next 3 years.
Okay.
So it's been about 8 months since we launched. We're just in the process of building our team. We've just appointed a India head. Right now, our product portfolio is mainly pickles and chutneys. And in terms of market, we only sell on e-commerce. So our own website as well as Amazon, Flipkart, Big Basket. And we've just got listed on quick commerce through Swiggy.
Okay.
And in the next 3 years, we hope to roll out modern trade and general trade both, but in a very phased manner. And quarter on quarter expand our product portfolio as well.
Okay. Sir, what are our target audience for Soul brand? Are we targeting to the upper class, middle class, or which type of audience?
So urban India, so I would say more upper middle class.
Upper middle class. Okay. And sir, what are our future plans, future product listing for Soul brand? Because as an India specific, this is my personal study that people, a whole country, I'm speaking about the whole country, are going for higher quality and higher prices of product, right? So we are moving towards premium products. So what are we looking up to?
Correct. So we hope to be in that premium space. In terms of product portfolio, I mean, Ashoka and ADF has a wide, extensive range of around 600 to 700 products, which we have access to because all the manufacturing is made in-house. So depending on the Indian market and depending on what's doing well and where we see not too much competition, we'll plan it out accordingly.
Okay.
But yeah, we hope to be in the premium space.
All right. Understood, sir. Thank you so much.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask question. We have our next question from the line of Tushar Khurana, an individual investor. Please go ahead.
Yeah, hi. Am I audible now?
Yes, sir.
Okay. Sir, I have question on ADF Soul again. So may I know what is the current turnover for ADF Soul right now, and how much cash are we burning?
So right now our revenue run rate is at about 45 lakh a month. So approximately 5 crores annually. And in terms of burn, Shardul, what is the cash loss?
So this year, as you are aware, we have committed 5 crores for the burn for brand building exercise which we are doing. Also, just on the number, monthly we are almost growing at around 50% in last few months. So, and that's how we are confident that the run rate going forward will keep increasing for our products, and we will be launching some of the new product ranges also in the next financial year. So that's something which we have planned for the Soul.
Okay. And sir, if I compare this Soul offerings that we have right now with, say, Ching's of Capital Foods, could there be a like-to-like comparison in terms of the offerings that Ching's has been offering and what we are foraying into? Am I getting it correctly?
So as it stands, the product range is only pickles and chutneys, which I believe Ching's doesn't do. But moving forward, I mean, Ashoka, we do have a wide range of Indo-Chinese sauces, and we're also launching noodles, which is somewhat similar to Ching's product range. And I mean, depending on the market size, we'll pick our categories accordingly.
Okay, and sir, on the branding side of ADF Soul, what are the steps that we're taking?
So right now, I mean, our presence is only on e-commerce. So we do a lot of social media, a lot of performance marketing. But because it's mainly online, that's pretty much all we do in terms of marketing.
Okay. That'll be all from my side. Thank you so much.
Thank you, sir. We have our next question from the line of Faisal Hawa, an individual investor. Please go ahead.
Sir, what is the capacity utilization of all our plants at this point of time? And if we increase the capacity utilization by at least 10 percentage points, what would be the kind of effect that it would have on our EBITDA and also on our ROC, ROE? That's one. And second is, can you give an example of one or two very key pivots that you have made in the last 9 to 10 months? When you have adopted one strategy and having seen it not work, we have pivoted to some other strategy, if at all that has happened.
Can you just repeat your last question?
Can you give an example of one or two pivots that we have made on strategy once we have seen that one strategy has not worked?
One strategy which is
Not worked. Nothing in the last 9 or 10 months.
So our capacity is 28,000 metric tons, and this is a overall capacity at Nasik and Nadiad both put together. I think depending on product lines, the capacities are utilized from 60 to 80%, and of course we have wherever required now we have done the debottlenecking. What we clearly see that for next 1.5 years, our existing plant will take care of our expanded capacity requirements, and by then our greenfield also will be operational. So in terms of the additional capex, I just mentioned, we have done 3.5 crores in the current year on the debottlenecking, and we have spent another 3.5 crores on the cold storage project which we have at Nadiad. Another 11 crores are committed for it. So this will all get over by April of the current year, and in the next financial year we will have a greenfield spending which is almost 60 crores. And in terms of strategy which didn't work, actually only thing which we are seeing some of this, I think there is nothing as such. I think we are all currently working on our strategy where we are increasing capacity on both production as well as on the distribution side. We have increased, I think we have invested in our people. So now there is a brand team which is for Ashoka, Truly Indian and Soul. It's been created, and they are all working on their product lines to expand the market share. I think maybe this question we can look at it after 2-3 quarters from now.
Thank you.
Thank you, sir. A reminder to all participants, you may press star and one to ask questions. We have a follow-up question from Devanshu Sampath from Avendus Wealth. Please go ahead.
Yes, sir. So 2 more queries. One is this update on Ekaterra supply chain, right? You said most of it is done, but you think, or at least in your discussions, you think by 4Q all of the issues can be resolved and we can go back to 100 CR distribution business for FY25, or can it possibly be more if we are, getting more products from them?
So what initially happened is that lead time for production went up from the 8 to 10 weeks which we were used to when Unilever was in charge to about 4 months, 4 to 4.5 months. So our entire forecasting and planning got a little disrupted. We're still facing some issues, but we're confident next financial year it should be streamlined.
Okay, so the 100 CR number, which was what we had seen in FY23, can we get a sense? Can you benchmark that and give me a sense on how it will be next year?
Yeah, I think once the supply chain issues are behind us, and also a couple of more principals we sign up, I think we should be in a position to achieve that.
Okay, so that we'll be required to add more principles. Okay, and second query I just had was on your truly Indian listings. In the sense, I think earlier you had mentioned that we're looking at something possibly next fiscal. So I would assume after the current quarter. So are we on track? Can you give a sense on what are the discussions, and if so, when can these be contributing to revenue?
Yeah, so we're still on track for next financial year. I mean, these things take a very long period of time. Tesco, for example, we were in discussions with for 8 to 10 months. But hopefully we'll have something by next financial year. All the range reviews are still going on.
Okay. Thank you.
Thank you, sir. A reminder to all participants, you may press star and one to ask questions. A reminder to all participants, you may press star and one to ask questions. We have our next question from the line of Richa from Equity Master. Please go ahead.
Sir, thank you for the opportunity. My question is again on margin. I think you shared something about the freight rates impact and the product mix, but still it's a substantial improvement both sequentially and year on year. So my question was assuming that freight rates don't go up and normalize, do you expect this 27% kind of margins to be maintained in future?
Yes. On the standalone, we should be in a position to maintain the similar. Actually, even on the console, whatever you are seeing, we should be in a position to maintain.
Okay. Thank you very much and all the best.
Thank you. We have our next question from the line of Kuber Chauhan from Anand Rathi. Please go ahead.
Yeah, am I audible?
Yes, sir. Please go ahead.
Yeah, just wanted to know that you said the capex for 11 crores, right, for FY25?
No, I said 11 crores capex is already committed on cold storage, which that cold storage will become live by April of the current year. So this is actually in next 4 months we will incur.
Okay, and you said the greenfield plant for Surat, it will cost around 16 crores, right?
60.
Okay. And I just wanted to clarify that will it be in the phased manner or will it be in the one shot?
Actually, 60 crores is for the phase 1 only. The Surat can become as big as Nadiad for us, and there'll be further phases which will come post that.
Okay. And any incremental debt we are planning for this?
Not really. We are sitting on cash of 140 crores. For Greenfield, we will take some loan because there is a grant which is available from the central government, which we have to run it through the lenders. So we will borrow some money for it, but otherwise there is no debt requirement as such for the Greenfield.
And how is the demand looking for next financial year? As the Red Sea issue crisis which is going on, and apart from that as well, how do you see the export market and also the Indian markets? That would be my last question.
So demand continues to be robust. The Red Sea issue is more a supply issue than a demand issue. But no, we're seeing good traction in all our new launches as well as our existing products.
Okay. Thank you.
Thank you, sir. We have our next question from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Hi, thanks for the opportunity. I'm just new to the company, so just wanted to understand some basic stuff.
Sorry to interrupt, sir. Can you please come closer to the phone?
I am close to the phone. Is it any better?
No, sir. You are sounding very distant.
Okay. Well, I can come back in the queue if this is not clear.
Sorry,
am I audible now? Can I go ahead?
Yes, please.
Yeah, so as I was saying, I'm new to the company. So just wanted to understand some basic stuff. The Ashoka brand has grown by 30% CAGR over the last 2 years, as you have shown in the deck. But if we look at the overall business on the processed food segment side, the growth is much lower. So what is the reason that the rest of the brands are not growing as much as Ashoka is growing? Is it just because they are not well established? If you can just give some color around that, that would be helpful.
Okay, as part of processed food, there is some, we used to have almost 30 to 35% share from B2B and private label. Now, all our businesses have actually, in terms of value, they have grown over the previous year. However, when we look at the percentage growth over in each of this, Ashoka has grown faster than everything else, while B2B and private label, in absolute or in percentage terms to the total turnover, they have reduced. So that share which used to be 30% plus is now down to around 20 to 22% for us. So that is something which has that's the explanation to your question.
Understood. And then in terms of our business that is coming from the US, what is that percentage of the processed food segment?
So we don't give the country-wise breakup, but US is the topmost market in terms of the market share. Large part of our sales of processed food come from the US business, and in fact, most of the distribution business is in US.
I see. So in terms of your, ethnic products market in the US, what would you say is your market share, roughly?
So we don't actually have any data as to market share, but I'd say in the US we'd be in the top 3 ethnic food brands. Indian food brands, specifically.
Okay. And what is the purpose of having this distribution business in the US? How does it add value to your process segment? Because given the margins, I would think you would want to focus more on the brand. So if you can just give some color as to why we have this business as well.
So it helps us with more. So one, there's cost synergies in terms of actually last mile delivery, and 2, it gives us more influence with the retailer as we have a wider product offering. In fact, since we signed on with Unilever, our Ashoka brand also grew in tandem. So we found that partnering with a good company with complementary products actually helps grow our own brand as well.
Okay. Wonderful. Thank you. That's all I have for now. But if I have more questions, I'll come back in the queue. Appreciate it.
Thank you, sir. We have our next question from the line of Rusmik Oza from 9 Rays Equi Research. Please go ahead.
Thanks for the opportunity. Sir, 9 months our EBITDA margins have moved up from last year 16.6 to this year 19.3. Just wanted to know, is there any built-up of PLI scheme benefits that is reflected in the EBITDA margins, or if you can indirectly give us what kind of amount we could receive this year in terms of PLI benefits?
So no, PLI is not a contributor to the EBITDA margin increase, which in fact you have seen. That's primarily because of the cost reductions which have happened and a better sales mix.
Okay. And if you can give some guidance or understanding what kind of PLI benefits we're getting in FY24, 25, 26 spread across the next 3 years?
So we will get PLI up to FY27. Total sanction to us is 62 CR. So that is an amount which will get spread over the 5 years from FY23 to FY27.
Okay, 23 to 27. And between 23 and 24, how much we could have realized or booked so that we can know the balance for the next 3 years?
So till now, we would have booked last financial year and the current 9 months, we would have booked around 10.5 to 11 crores of PLI income.
Okay. And any guidance, how much out of the balance, how much will be coming next year in FY25?
Around 9 odd crores.
9 crores. Okay. This is helpful. Thank you so much.
Yes.
Thank you, sir. We have our next question from the line of Kanav Garg from Garg Advisors. Please go ahead.
Yeah. Hi, sir. Good evening. So I have 2 questions. One question is that, do we maintain any safety stock, let's say, in export geographies? I mean, I think you mentioned that on the key reasons where we lost some growth was because of the shipments not happening. So since we have warehouses, so doesn't that help us in meeting the customer demand? That is my first question.
So warehouse, in fact, this is one reason why we have now built our warehousing capabilities in our largest market in US. The freezer capacity wasn't really available. It just became commissioned from the month of, in fact, last month of like November, December, it got commissioned for us. Going forward, in fact, there will be stocks which we will maintain in our warehouse. But however, what happens is, again, this is one region in US where we can stock. I think the rest of the US, it is through the distributors we have to do it.
So for distributors, for those distributors, can't we stock at that warehouse that we will be creating? Or it will be too expensive?
So we do that as well for the entire East Coast, but to bring it from the East Coast to the West Coast or even the center of the US becomes too expensive. I mean, your sea freight is cheaper than your inland cost.
Okay, makes sense. So secondly, I think you just said that we are on track of that 17-18% guidance that we had given. So let's say in 9 months we have done 300 crores in processed food segment. I think last year it was 362 crores. I mean, are we saying that we will be able to do like 120 odd crores in the processed food segment for Q4?
Yes, that's what we meant actually.
Okay. And sir, my last question is on e-commerce. I think you just said that for India, we are focusing on e-commerce channel. I mean, what I understand is on e-commerce channels, I mean, it's quite costly to get the shelf space and, to maintain the inventory. I mean, depending on the model that you're working with, let's say Amazon or Flipkart or whatever e-commerce channels you are using. I mean, what is the cost that we incur there? I mean, I just want to understand the strategy there in e-commerce. How are we, entering into the e-commerce segment, and how are we planning to grow our business in that channel?
So you're right, it is expensive, but it's still fairly less expensive as compared to modern trade and general trade. And another advantage of e-commerce is we get first-hand feedback both on secondary sales, demographic, what's working, what's not working. And in terms of expense, so it's performance marketing, which is your digital ads, and warehousing cost, which is still, again, cheaper on e-commerce as compared to modern trade and general trade.
Okay. So let's say if you are... if you are in connection with Flipkart, I mean, if you're selling at Flipkart, so Flipkart might come and tell you, this particular pickle is not selling, or this is the X type of pickle which actually sells in the market. So basically, you take that feedback and try to produce a pickle which actually sells in the market. I mean, is my understanding correct? That's why you're using the feedback loop there?
Yes, to a certain extent, yes.
Great. So that, like, the scale-up that you're saying, I mean, it's just 40 lakhs. I mean, what we have seen is that in case of e-commerce, the scale-ups have been, like, massive. Like, if you want to scale up in 2-3 years, you can practically go, like, 50, 70, 80x, even at a small base of, let's say, 1 crore. I mean, are we giving conservative targets, or, like, what's the difference there? I mean, it just doesn't make sense. I mean, the scale-up seems to be slow. I mean, there must be some strategies. I'm trying to understand that.
So, if you look at our past three to 4 months, we've been growing at about 15% month on month, which is a fairly fast ramp up in our opinion. And in terms of targets, we're looking at 100 crores in 3 years, which a lot of brands haven't been able to do, especially in a complex landscape like India.
Oh, great. That makes sense. I mean, that's something I wanted to understand, because e-commerce grows very fast, right? I think till 500 crore, it's something we can grow very fast, and then beyond that, it becomes a bit problematic. Great, sir. Thank you. Wish you good luck.
Thank you.
Thank you, sir. We have our next question from the line of Rasmik Oza from 9 Rays Equity Research. Please go ahead.
Yeah, thanks for the follow-up opportunity. I had a follow-on question on the same PLI scheme. So you clarified that you would be booking 11 crores between 23-24, 9 crores in 25. That takes to 20 CR. That means out of the balance 62, does it mean that we're going to book almost 42 crores of PLI between 26 and 27 in that 2 fiscal years? That's my first question. And second is, what are the conditions? I presume it is based on creating brand globally. So are we meeting the required norms for getting this PLI benefit?
So what we do is, I think we are not booking the entire PLI eligibility in accounts unless and until the money is received. So hence, that's the number which you asked me about the accounting, how much we will be accounting. But in terms of ramp up PLI, the way it works is year on year it will keep going up. So in the last financial year, because it's also depending on the sales growth which the company will be achieving. The conditions for PLI for us is we get the reimbursement of the marketing spend which we are doing in the overseas market. 3% of the top line or 50% of the spend, whichever is less, is what we get it back from the government.
Okay. So maybe what could be the run rate which can come in FY26 and then FY27, just to get a ballpark figure?
Run rate in terms of?
The PLI benefit, like you mentioned, you would maybe book around 9 crores in FY25.
Yeah, it will go in the range of 15, 16 crores and then to 20 crores. Right? I think that's how it will go.
Okay. This helps, sir. Thank you so much. Yeah.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. A reminder to all participants, you may press star and 1 to ask questions. As there are no further questions, I would now like to hand the conference over to management for closing comments.
Yeah, I thank you all of you to attend our con call and hear our thought process. Thank you.
Thank you.
On behalf of ADF Foods Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.